Welcome to Growth Investing Mastery. This video is about alternative banking. It's a new emerging industry, and we're going to reveal 4 stock names today. As a reminder, this is not investment advice or recommendations to buy any stocks. The topics for this video will include looking at alternative banking, which is a new booming industry, and then we'll look at big trends versus hidden trends for growth investing. We'll discuss the 4 growth stock names I mentioned, which show a lot of promise, and we'll talk about why these banking products are now taking off. Then we'll examine the financials for the companies mentioned and look at the products and narratives. Lastly, we'll summarize our findings about alternative banking. Let's talk about trends for an emerging industry. Some big trends are really obvious, like the 2000s internet bubble, or AI in 2023. The growth in these industries was universally recognized by nearly everybody as being a big trend. However, sometimes a new business model can go unrecognized by the market, which was the case with software as a service. From about 2010 till 2021, software as a service grew tremendously in the marketplace, along with cloud computing stocks. And many of these companies went public at what seemed like incredibly low valuations when we consider their business now. For example, Shopify went public with a $2 billion market cap, and Cloudflare went public with a $5 billion market cap. Then there's trends which are much lesser known, and these can present huge opportunities. One example I'll give was around 2008 when casual dining really took off. There was 3 stocks I owned which did really well, which were Chipotle, Panera, and Buffalo Wild Wings. Both Panera and Buffalo Wild Wings eventually got acquired. However, Chipotle still trades as an independent stock. And one bit of evidence I had for Chipotle being a big winner was there was a lot of Chipotles near me, and they always had lines out the door, which was a big confirmation, along with really strong financials and new restaurant openings. And that discussion of casual restaurants ties into this presentation because I believe alternative banking may be one of these lesser-known trends. And the market's really starting to wake up to the opportunity here as these companies post really impressive financials. And I'll add I originally had a bias here against these type of companies as I thought they were taking advantage of consumers. However, as I've learned more about these alternative banking solutions, it seems like it's traditional banks which are taking advantage of consumers. The 4 growth stock names in the alternative banking sector are Sezzle with symbol SEZL, Paysign with symbol PAYS, Dave Inc with symbol Dave, and Propel Holdings with symbol PRL.TO. The .TO at the end signifies the company is traded on the Toronto or Canadian exchange. Let's briefly discuss the products for these 4 companies. Sezzle is a company we've talked about a fair amount on this channel, and they are a buy now, pay later solution which builds credit for users. Paysign has products which include prepaid medical cards and other healthcare products, along with reimbursements for employers, and we'll talk more about the product later on. Dave Inc offers digital banking services, cash advances, overdraft protection, and credit for its users. And lastly, Propel Holdings, they have online credit solutions, and they use a lot of AI underwriting for their products. I currently have a 15.5% position in Sezzle, a 1.8% position in Paysign, and then I have a 0.8% position in Dave Inc. And lastly, Propel Holdings is on a watch list, but I don't own any shares there yet. Let's now look at why these 4 businesses are doing so well recently. Traditional banking is tightening credit and making it more challenging for consumers to obtain credit. Newer AI models allow alternative banks to make safe bets, giving credit to consumers that traditional banks won't lend to. And I recently learned that buy now, pay later is actually aligned with responsible payment. Many of these companies like Sezzle will not allow a consumer to go massively in debt, and they'll simply cut them off if they don't make the repayments. That's a lot different than traditional credit cards, which can charge an egregious APR to an unsuspecting consumer. The CEO of Sezzle said consumer sentiment is dropping, and many consumers seek out flexibility in their finances in uncertain times. While the CEO of Propel had a number of quotes which explain why all these businesses are booming recently. He said, "Demand for credit remains elevated, but more difficult for consumers to access." Additionally, he added, "We have seen several major U.S. banks shift their lending to more affluent households, away from lower income households." He added, "We believe the macroeconomic trends will continue to be a net favorable for us." And I thought that was really interesting that these businesses actually benefit from challenging macroeconomic conditions. Additionally, unified fee structures and lower fees overall help keep expenses in check. Credit demand is actually exceeding credit supply for consumers, and the low barrier to entry for these businesses brings more consumers through the funnel. Lastly, many users are simply fed up with traditional banking, whether it's the credit system, APRs on credit cards, or overdraft fees at their bank. Let's now take a look at the financials these four companies posted on their latest earnings reports. Sezzle had $105 million of revenue, which is up 123% year over year. That's the fastest growth rate of the four companies. They also have a gross margin of 71%, which is the highest of the four companies. GAAP EBITDA came in at $63 million and net income was $36 million. The market cap is $3.29 billion and cash is $89 million with debt of $71 million. While Sezzle has the most impressive financials of the four, it does have the highest market cap, so the market is recognizing the growth potential here. Next, we have Paysign with revenue of $19 million, which is up 41% year over year. That makes it the smallest of the four companies we're looking at here. Gross margin came in at 63%. EBITDA came in at $4.3 million, and net income came in at $2.6 million. The market cap is just $197 million, so it's definitely the smallest of the companies here. And the cash on its balance sheet is $6.8 million with debt of $2.8 million. Next, Dave posted revenue of $108 million, which is up 47% year over year. They have a gross margin of 68%. EBITDA came in at $37 million with net income of $29 million, and the market cap is $2.43 billion. Cash for Dave is $88 million, and they have a debt of $76 million. And when we compare the market cap of Sezzle to Dave, Sezzle's not that much bigger, but they're growing much faster. And this is part of the reason why I have Sezzle as a much bigger allocation than Dave. I feel the valuation and growth prospects for Sezzle are a bit better than Dave right now. Lastly, we have Propel, which posted revenue of $139 million. That was up 44% year over year, and gross margins 58%. They have the lowest gross margin of the group, but EBITDA was pretty strong at $42 million with net income of $24 million. The market cap in dollars is $930 million, but they measure in Canadian dollars, which was $1.27 billion. Cash for Propel was $29 million and debt was $274 million. And you can see here, Propel is the one company that has a lot of debt, which greatly outweighs their cash balance. So that is a real concern of mine. Although with $139 million of revenue, the market cap at $930 million doesn't seem that much. So the valuation is pretty attractive for Propel. However, there are some aspects of the Propel product which I'm not that enthusiastic about, and we'll get into that part in a bit. One impressive commonality between all these companies is the revenue growth rate is above 40% year over year, and all the companies are GAAP profitable, measured on both net income and EBITDA. Let's now take a look at one of the big competitors in the space. Affirm is a Silicon Valley competitor, and they raised a ton of money through the traditional VC process. If we take a look at their financials, they have $783 million of revenue, which was up 36% year over year. The gross margin is 45%, which is lower than any of the four companies we just looked at. EBITDA landed at $62 million, while net income was $2.8 million. And you can see on $783 million of revenue, they're earning just $2.8 million in net income, which is tiny. The market cap for this company is $16.7 billion, and they have cash of 1.89 billion, but debt of 7.36 billion. So this company has a huge amount of debt, and their growth rate is lower than the rest of the companies we're looking at. Additionally, even though this company should be scaled up a lot at this point, they do have low net income and a low gross margin compared to the companies we're really looking at. Even Sezzle generated more EBITDA than Affirm in the latest quarter, and way more net income, while Paysign earned nearly as much net income as Affirm, and Paysign is a very small company, keep in mind. When we look at the net income trend for Affirm, it's not very impressive. Looking back over the past year, it went from negative 134 million to negative 45 to negative 100 to 80 and then to 2.8 million. And with Affirm having almost about half its market cap as debt, that's a really unattractive quality for an investment here. However, I do feel that Affirm shows the potential upside for the other four companies we're looking at, because the market cap is almost 17 billion, and a lot of these financials they're posting aren't that attractive. That leads me to believe there's additional upside for the four companies we're investigating here. Now we'll look at another competitor, which business model seems to be failing. This company is Klarna, and the market cap is estimated to be 15 billion. It's still a private company. The company was supposed to go public this year, but they've delayed their IPO, and the reason they stated is it's due to global market instability. However, when we looked at the four other companies, they were benefiting from the uncertain macro environment. In Q1, Klarna reported a loss of 99 million, and that's double the loss of 47 million they reported in Q1 of 2024. So even though this company should be scaling up and getting more profitable, their losses are actually growing here. And Klarna is a bit infamous in the marketplace, as they fired nearly 700 employees to replace them with AI. However, now the company is backtracking and saying they went too far and they need to rehire some people. And the company has a really poor anecdotal reputation that I've seen online, as a lot of people have been trolling them for replacing so many employees with AI. This really raises the question why Affirm and Klarna are running losses, why these smaller competitors have huge profit margins and are doing much better. And for example, Sezzle's talked openly about how they've raised the least amount of money from competitors, yet their profit margins are higher than anybody's. And I believe Klarna and Affirm show the failed business model of Silicon Valley in this field. These two companies raised a ton of money through the traditional VC process, and they hired so many employees with very high stock-based comp. But now, even though the companies are running at huge scale, they're struggling to even make a profit. Now let's dive into some of the products and narratives of these companies to find out why their business model is so compelling. Sezzle has two programs. One's called Pay in 4 and the other is called Pay in 5. And this offers no interest, no hidden fees, instant approval, there's no hard credit check, and there's flexible rescheduling of payments. Sezzle's product, which is really taking off, is called On Demand, and it's a single-use virtual card. It can be used at any retailer now, not just Sezzle Partners, which is a change from the previous model, and it offers instant approval. There's also a product marketplace, which users are finding compelling. It generates AI-powered recommendations, and it gives users price alerts for compelling prices. There's curated collections, and they're also offering coupons, which can be auto-applied. Additionally, there's long-term payment plans, and they can be extended repayment terms with interest-free options for qualifying purchases. The credit-building tools that Sezzle offers are really compelling for users. They can help users build or rebuild their credit history if they make on-time payments. They also offer exclusive deals and offers and personalized offers with notifications within the app. Let's continue on looking at a few more details of Sezzle's products. They offer instant approval for signing up, and it's a quick sign-up process that has no initial impact on the credit score. There's potentially flexible rescheduling, which is a one-time free payment reschedule per order for unforeseen events. And I think this is really where Sezzle's building a lot of goodwill with its users. For example, a bank will never let you reschedule something just because of an unforeseen event. Sezzle is a certified B corporation, which emphasizes responsible spending and credit building. And Sezzle also has partnerships with over 40,000 merchants in the US and Canada. And the merchant has no credit risk. The merchant gets paid no matter what, while Sezzle assumes all the credit risk. So this also buys a lot of goodwill from the merchants who can integrate Sezzle without any additional risk for them. Now let's dive into a review of the Sezzle narrative from the latest earnings report. They saw better than expected repayment performance on gross merchandise volume from quarter four. And there was 77% year-over-year growth in monthly on-demand users, which they call mods. The company signed 2 new enterprise merchants in the quarter, and the web bank partnership brought a unified fee structure. This unified fee structure and web bank partnership is really helping the business take off. Net income margin came in at 34.5%, and adjusted EBITDA margin was 49%. That's really impressive profitability metrics, especially when you compare to Affirm and Klarna, which we discussed are running at losses. Sezzle gave a huge guidance raise for full year 2025. They raised the revenue guidance for 2025 from 20 to 30% to go up to 60 to 65%. Sezzle also revised their EPS guidance to go from 2.21 to 3.25, a huge jump up. And the CEO mentioned that demand is strong in Q1, which is usually their seasonally softest quarter, as Q4 is the holiday season. The on-demand product is seeing monthly sequential growth right now. And the company mentions this phrase, ease of use equals ease of mind, and they really like to emphasize how easy it is for their users to onboard to the products. And they've got a lot of newer products coming out, like the auto-applying coupons and the marketplace, and it seems like these are really catching on with users as well. Now we'll look at the Paysign product. They have a lot of prepaid card programs, and the cards are reloadable, customizable, and they integrate with Visa. And their target market for this is healthcare, pharma, retail, plasma centers, hospitality, small businesses, and government. They also offer corporate rewards and incentives and corporate disbursements. And this is so a business can give out rewards to its customers or employees. There's also patient affordability solutions, and this offers copay assistance and travel and lodging reimbursement. The target market for this is pharmaceutical and healthcare. I'm not quite sure how this part of the business model works exactly with the patient programs, because I'm not sure how they make money from this, but I'm still learning about this business. Additionally, they have donor compensation programs, and this is used at places like plasma centers and clinical trials. Paysign offers digital banking, which they call Paysign Premier. And this does kind of sound like a traditional banking service. They say it's a modern digital bank with early direct deposit and card management. It's FDIC insured, they have a mobile app, cashback, pharmacy discounts, and it does seem like it's targeted towards the healthcare market still. There is a gift and rebate card payment program, and that's in addition to integrated payment processing. The payment processing is offered to business, which offers end-to-end payout processing for payroll and reimbursements and stuff like this. They advertise this as secure, compliant, and they have API integrations. So it does sound like a technology company or a technology product. And lastly, there's a pharmaceutical services suite. This offers centralized billing, record management, compliance analytics, and the target market for this is pharma and rare disease support. Some additional features that Paysign offers is a mobile app. And through the app, cardholders can manage balances, transactions, and get alerts. There's also custom collateral, and I think this is a white label program for custom branding that's tailored for each client. And we mentioned API integration. They have a seamless integration that connects to different healthcare platforms. They also offer that there's extensive customer support, which works around the clock. and there's bilingual agents who are on standby to address any concerns that users may have. So Paysign does seem to be going after offering impressive customer service for their products. Looking into the Paysign narrative, in Q1 they added 14 new patient affordability programs, and that makes them end with 90 active programs in the quarter. Processed claims grew 160% year over year, and revenue from patient affordability grew 261% year over year. Those are incredibly impressive stats. However, their plasma centers declined 9% year over year. And part of the reason the company said plasma centers are declining is plasma centers are actually fully booked right now. There was a company called ADMA Biologics that I used to invest in with symbol ADMA, and they're a big user of Paysign. Paysign is actually an exclusive partner with ADMA, so if you donate plasma through them, then they'll give you a prepaid Paysign card. So it really is a tale of two sides of a business where patient affordability is growing incredibly fast, but the plasma center side is not doing as well. Management did add that the fundamentals of our business remain exceptionally healthy. Additionally, they said the sales cycle is efficient, and it's between 90 to 120 days. The company recently acquired another company called Gamma Innovation, and they're a front-end management platform. They say the early results are already paying off. Gamma adds between 4 to 5 million of annual cash flow, with adding other efficiencies to the entire Paysign platform. My biggest concern right now is that the full year guide is only for 25% revenue growth. Let's now take a look at the products that Dave offers its users. Dave has an option called Extra Cash, and users can get a cash advance for up to $500. There's no interest, no credit check, and it's fast access. But there is an express fee for instant transfer if a user wants that. There's also Dave Checking, which is a digital checking account. It offers early payday, no hidden fees, and a debit card. Additionally, there's no minimum balance and no ATM fees. The no ATM fees is quite a contrast to other traditional banks, which try to charge users for each ATM transaction. Additionally, Dave has a goals account, it's called, and it's a high yield savings account. It's roughly 4% APY and offers flexible deposits. The APY can be variable sometimes as well. Lastly, they have a program called Side Hustle, which is a job and gig finding platform. There's surveys, instant payouts, and there's a job board for people to post gig jobs. And the Side Hustle is included with a Dave membership. And you'll notice the Dave product slide is quite a bit shorter than the rest of the ones, so it does offer a concise product lineup. Looking into the Dave narrative, the company outperformed expectations across key areas of the business. Management said they're seeing operating leverage, a fixed cost base, and margin expansion, all of which are very good for investors. There is a new fee structure for Extra Cash, and results are better than expected. If you remember from Sezzle, they are also seeing a unified fee structure, which was boosting results. So that is one commonality between these businesses. Management added there's a higher lifetime value on customers since the fee change. There's also efficient member acquisition, and delinquency rates are improving. That's in addition to higher average revenue per origination. The company said Cash AI, which is a product, has allowed us to build a moat and a flywheel. There's nice growth in the Dave card, as management mentioned. The customer acquisition cost is $18, and they view that to be incredibly efficient. Guidance for the company was recently raised to 33 to 37% revenue growth. My biggest concern with Dave is there's some ongoing litigation with the Department of Justice on advertising practices. And I believe the allegations were that they weren't advertising the interest rates properly and had some other things they needed to disclose to users, which they weren't doing. I do believe Dave will probably be able to resolve this, maybe through a fine or something, but it is a pretty big concern of mine, and one reason I'm keeping this position really small right now, why I learned more about that litigation. Now let's jump into the product that Propel offers. They have four separate brands, with the first being Credit Fresh, which offers lines of credit. The lines of credit are fully integrated with the digital banking solutions, and this is currently offered to only U.S. residents. Even though this is a Canadian company, the vast majority of revenue comes from the U.S. They also have MoneyKey, which overlaps a little bit with Credit Fresh, as they offer lines of credit and installment loans. This is a state-licensed direct lender offering unsecured installment loans. Fora Credit is consumer credit, and it provides access to credit for underserved consumers. This site uses Propel's AI technology to do the underwriting, and this site serves the US and Canada. Lastly, there's Quid Market, which is a result of a recent acquisition, and this offers short-term loans to people in the UK. Since this company has four distinct websites and platforms, that is one of my biggest concerns, that they have this kind of hodgepodge of platforms, and it may not be all integrated together. That may be part of the reason the valuation on this one is so attractive compared to the others, because it's not this type of unified platform. Looking into the Propel products a bit more, we discussed they have installment loans, lines of credit, and short-term loans. But they also offer lending as a service, which they call LAS, and it's a white label embedded lending platform for partners. That works directly with the Propel platform. They also have embedded lending, which are credit products that are integrated into partner platforms. I'm not quite sure on the difference between lending as a service and embedded lending. Those sound pretty similar, so there may be some more to learn about these products. Let's check out some of the narratives surrounding Propel. They said, "We're off to an exceptionally strong start to the year." The company saw records for revenue, adjusted EBITDA, and net income, and that's in the typically slowest demand quarter of Q1. The company also originated record volume for the Q1 period. It's the strongest credit performance they've seen since Q2 of 2021, and regarding tariffs, the company said, "Our business is not directly affected by the tariffs." That's really encouraging to see that this business doesn't have a tariff impact, and that aligns with what the other three companies said as well, that the uncertain macro environment actually benefits these companies. Surprisingly, most of the revenue for Propel comes from the US, even though they're listed on the Toronto Exchange, and Canada makes up only 5% of revenue. The company completed its first full quarter since acquiring Quid Markets, which opens up their solutions to the UK market. The Quid Markets acquisition is getting record revenue and strong credit performance so far. Management mentioned they're seeing strong consumer demand across all their operating brands. The lending as a service product generated strong revenue in Q1 as well. And the company's provision for loan losses makes up 42% of revenue, which is down from 44% last year. While it's not a huge improvement overall, it's good to see that numbers going down as a percentage of revenue. The company has a partnership with R&R Bank, which has a disciplined underwriting approach. I'm not too familiar with R&R Bank, so that's something to look into a bit more. And on the earnings call, they mentioned there's elevated demand across operating regions more than a month into Q2. So it's good to see this company is already mentioning that Q2 is off to a strong start. My biggest concern with this company is they offer this diverse set of different websites and programs. And I'm concerned with this acquisition that they could end up turning into a kind of Frankenstein business where they own all these different platforms which aren't really integrated well. But overall, the numbers are really impressive and the narrative sounds pretty compelling for this company. Let's now summarize our findings from this video. Alternative banking is a new trend that is really promising for growth investors. Traditional banks are tightening their credit loan standards in uncertain economic times, and that benefits all four of these companies we discussed. Each of these companies has impressive financials on its own right. To be clear, this isn't a spread bet, but each company's financials and narrative are compelling on their own. These four companies demonstrate strong business models with GAAP profitability early on in their journey. And they've all figured out how to scale up without overspending. That's in big contrast to companies like Affirm and Klarna, which have over 15 billion of market cap, but they have out of control expenses and they're struggling to reach profitability. The market is really starting to warm up to these names as well, as companies like Sezzle and Dave have already had a big run up. However, from my perspective, the growth prospects for these companies remain strong, and I think there's still room to run for the companies. This concludes our video on alternative banking, and I'd be really interested for your feedback on which of these four companies seems the most promising. If you enjoyed the video, leave me a comment or a like below. As a reminder, this is not investment advice or recommendations to buy any of these stocks. Thank you.